Okay, so you're here with us because you've been looking at what's going on in the markets and thinking about 2008, sending over some articles, seeing some parallels. And what we're going to do is really dig deep and try and see what the key similarities are. But more importantly, really, tease out what are the differences here. We don't want to overload you with a ton of data. We're really just looking for clarity.
Yeah, and I think, the article you sent over had a great quote in there, kind of echoing Tolstoy. All bull runs are alike, but every market crash is unique. And I think that's really what we want to try and unpack here with the data. What is unique about what we're seeing?
Yeah, exactly.
And just to give you a sense of the scale, back in 2008, we had a peak on January 4th, and then really, really fast. By October 27th, so less than 10 months, the market had crashed a whopping 64%. If we look at more recent times, the peak was around September 26, 2024. And as of March 7th this year, we're down a little over 16%. And you can already see, the difference in terms of the sheer drop. We've got this market analysis here, and we're really going to unpack what it tells us for you.
And as we go through this, we'd love to hear what you guys think. So please drop your other opinions in the comments below. Make sure you're subscribed to The Other Opinion for more of these in-depth discussions. And if you find this useful, share it around with your friends.
So let's kind of break this down. Let's start by looking at how expensive stocks were leading up to these downturns. And the analysis actually looks at the price to earnings ratio at the peak. So back in January 2008, it was about 27 times earnings.
And as of September 2024?
Yeah, in September 2024, it's a little higher at about 28 times.
So by that metric, it was slightly more expensive.
Yeah, a little bit. But when you look at the price to book value at those same peaks, we get a slightly different picture. So in January 2008, it was at 6.3 times, which was quite elevated.
Yeah.
But as of September 2024, it was 4.2 times.
So lower.
So this suggests that perhaps the 2008 run-up had more of a speculative bubble-like quality, when you consider the relationship between market value and the underlying assets.
Then if you look at how far those valuations actually fell by October 27, 2008, the price-to-earnings ratio had plummeted to just 9.3 times. The price-to-book ratio was just 1.8 times. And as the article says, stocks became attractively priced, which is putting it mildly.
Yeah, definitely. And if we look at more recent times, March 7, 2025, the price to earnings ratio is at 22.5 times, price to book is 3.5 times. So while the valuations have come down, they're still not at those, crazy levels we saw in 2008.
So we can see, both periods, high valuations before the downturn, but the degree of the overvaluation and then the correction, is significantly different. These initial data points are already telling us that these weren't just two, similar blips in the market.
Right. And it really brings us to, I think, another critical distinction that article raises, which is the contrasting roles of foreign institutional investors versus domestic retail investors in those two periods.
Okay.
So if we think back to 2008, between January and October, foreign institutional investors, or FIIs, were significant net sellers of Indian stocks to the tune of 52,937 crore.
And what's interesting is during that same period, the amount flowing into equity mutual funds from retail investors was actually quite small, only about 5,856 crore.
Right.
So as the analysis points out that the selling pressure from these big foreign players was much greater than the buying interest from domestic investors, and the retail investor base itself was much smaller back then. There were only about 1 crore unique registered investors, according to the NSE data.
So now fast forward to the present, from October 2024 to March 7, 2025. FIs again have been net sellers this time. It was a much larger figure, though, at 2.38 lakh crore. Yeah. Even if you just look at October 2024 to January 2025, the net selling was 1.78 lakh crore, so still substantial.
And that's interesting because during that same period, in October 2024 to January 2025, the net inflow into equity mutual funds was 1.59 lakh crore.
Right.
So a huge amount of money coming from local investors and, really acting as a counter to the FIS selling. And the number of unique registered investors as of January 20th had crossed 11 crore.
Wow.
According to NSE data.
So that's a huge increase in retail participation.
Massive, yeah.
And I think this difference in retail involvement is really key here. So the strength of this SIP flows, combined with just a much larger retail base, has really acted as a shock absorber this time around, really slowing down the pace of the fall compared to what we saw in 2008. What do you think about that?
Yeah. I mean, I think it speaks to maybe an increasing level of sophistication from the, local investor. The article mentions that SIPs have become, really mainstream, almost a cultural norm for investing, which just wasn't the case back in 2008. Mm-hmm. And for anyone listening who's, maybe newer to all this. SIPs are basically, regular fixed investments into mutual funds, which allow you to benefit from something called cost averaging.
Yeah.
Um, and,
And cost averaging works by basically, having you buy more units when the price is lower, fewer units when the price is higher. And over the long run, it smooths out your average purchase price and reduces your overall investment risk.
Yeah.
The article makes a good point that, 16% fall isn't going to give you huge benefits from cost averaging just yet, but it definitely slows down the wealth destruction and it keeps people in the game.
Yeah. And I think, for anybody listening who's really enjoying this analysis, make sure to like and share this episode with your friends. Give us those other opinions in the comments, and please subscribe to The Other Opinion for more deep dives.
Absolutely.
So let's zoom out a bit and look at the overall economic context, because this is another area where things look quite different now compared to back in 2008. The analysis that you sent emphasizes that 2008 was very much driven by a full-blown global financial crisis. We had problems in the U.S. housing market that spread rapidly and destabilized the entire financial system.
Right. And in 2025, while there are definitely global economic uncertainties, the article points to some of those. The fundamental plumbing of the financial system is not really facing the same existential threat that it was back then. So that provides a much more resilient foundation compared to the panic and credit freezes we saw in 2008.
Right. But the analysis does caution that even after the recent fall, Indian stocks still appear overvalued by the price-to-book ratio, which is at about 3.5 times compared to its long-term average of about 3.0 times. And that's in contrast to the situation after the decline of 2008, when valuations had fallen and, stocks were no longer overvalued.
I think that brings us to a key takeaway for you, our listener, regarding your investment strategy. So while, this recent fall hasn't been as dramatic as 2008, the starting valuations were high, the correction hasn't been as deep, and it underscores, the importance of thinking about market valuations and your long-term goals.
Yeah.
And if you're not already, make sure to subscribe to The Other Opinion so you don't miss out on future deep dives into these kinds of topics. And, if you have friends who are interested in this kind of stuff, share it around.
So just to recap what we've explored so far, both 2008 and the recent period involved market downturns, but the scale of the 2008 crash was far greater.
Yeah.
The valuation levels at the peaks were different, with that price-to-book ratio suggesting a larger bubble in 2008. And very importantly, we've got much higher retail investor participation now, which is driven by the growth in SIPs. And that's acted as a buffer compared to 2008, when it was really heavy selling by foreign investors.
Right. And we also can't forget the broader economic context. 2008 was really about that systemic global financial crisis, which thankfully we're not seeing right now. But the article does remind us that current valuations, while corrected, are still not at those historically low levels we saw after the 2008 crash.
Right. And I think this really reinforces a really crucial principle, for managing your investments, and that's diversification.
Yeah.
So spreading your investments across different types of assets, stocks, mutual funds, fixed deposits, even gold, and diversifying within those categories is really key to protecting your wealth and managing risk.
Yeah.
You don't want to put all your eggs in one basket.
And I think, taking a step back and considering these differences between now and 2008, what does this tell us about how the Indian market is maturing and, the growing influence of the local investor? Is this increased retail participation a long-term source of stability, or does it bring in, new kinds of market behavior we need to be aware of?
I think that's a really important question.
We'd love to see your other opinions on this, so please leave those in the comments below and, like and share this deep dive if you found it useful.
And just one final note, this deep dive was created using AI, which aims to, provide information. But it's important to remember that some of the details might not be completely accurate. So please do your own thorough research before making any financial decisions. Thanks for joining us for this deep dive on The Other Opinion.